Hey everybody, I hope you're having a great Sunday. So we've got another week of trading coming up. I'm sure it'll be an eventful one. I'm going to do a little bit longer video later on today to talk about things a little bit more in depth. But for today, I wanted to talk about this Vanna effect that you may have heard that has been happening, that might have happened on Friday. And I talked a little bit about that earlier in the week. Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. And I said, listen, on the way down, if we sort of start to get through that 5,800 level, we could be in a little bit of trouble partially from this Vanna effect as market makers have to sell into a sell-off. That Vanna effect, as implied volatility rises, those deltas rise. They have to sell more against those put positions, and that serves to create a little bit more of a snowball effect to the downside. So to the downside, that Vanna effect can often cause problems, which of course are exacerbated by all the synthetic gamma coming from leveraged ETFs, et cetera, and all that stuff. We don't have to get into that right now. Now, the opposite can happen as well. So I wanted to talk a little bit about that. We had, the market starting to really stare into the abyss, down, probably 400 points from the high. So certainly had already a fairly good sell-off. For now, sold off again after that NFP number, and then found a little bit of stability down in that sort of 56, 70 area on the index, started to rally. Then we got some positive comments, or at least comments that the market deemed positive from Jerome Powell. He's keeping an eye on things. You have to watch things. Okay, great. So maybe it makes people feel like, okay, just, that's a slight positive. And given the extreme sell-off to that point, it was a chance for things to rally. And so as implied volatility drops, let's talk about how Vanna can help to the upside as well. So it's kind of pushing things around and making things not so fun for market makers who are short gamma, short vega. So Vanna, let's say on the way down, the market maker is short 100 of the puts. We don't even have to put really a strike on there, but let's say the puts are a 35 delta. As implied volatility rises, the delta, all else being equal, will go to, let's say, goes to 40. So now the dealer up here has to sell 3,500 shares against those 100 puts that they're short, and as a hedge, because they are sort of continually hedging, depending on the house, depending on the firm, et cetera. Definitely depends. When I was a market maker, I would sometimes let my deltas run for days. So, but generally with people with sort of institutional books and trying to really make a market and facilitate trades for clients and people like that, they're probably doing quite a bit more hedging than the average person who's taking maybe a directional bias. So 3,500 shares short against those puts. What happens as IV rises? The delta, all else being equal. So let's say nothing else has changed. The index is basically the same level. The index, the IV rises. The delta on those goes to 40. What do they have to sell? Now they have to sell 4,000 shares, right? Sell 4,000 shares. So they've had to sell an extra 500 shares just because the implied volatility went up on those puts. Now, what happens to the upside? Papa Powell comes out, gives the market some soothing words. The market's a little bit oversold. IV starts to drop, right? We have a little bit of a pullback in the VIX, and let's say the market maker is now short their 4,000 shares. IV drops this time, and the delta becomes 35. Now, what happens? Well, they should be short 3,500 shares because the delta of 0.35 times 10,000 shares from being short 100 puts means you have to be short 3,500 shares to be delta neutral, right? We're trying to neutralize our risk so that a move up or down isn't really going to be impactful. all else being equal. So that's the idea of being delta neutral for the market maker. To try to not take too many directional ideas, biases, basically. So now the IV drops and the delta goes from 40 down to 35. What happens? Well, they should only be short 3,500 shares, but they're short 4,000 shares. So they are over hedged. Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to options ninja. Now back to the video. So the market is rising. The market maker is over hedged, right? Now they've made a little bit of money on Vega there. The implied volatility is dropping, so they've made a little bit of money, which is great for them. But they are over hedged and need to buy 500 shares. Now, what happens if the VIX comes down even more as the market rises? Same thing. So the more the IV comes down, the higher the Vanna effect becomes, right? So on the way down, dealers had to sell extra stock because they were underhedged due to an implied volatility rise. On the way up, the opposite happens. The IV is coming down, the delta drops on those positions, and they are now overhedged and they need to buy stock on the way up. So this is part of the reason it's not very much fun being short gamma. I mean, every market maker has to deal with that. If they're sort of liquidity providers, they have to take the other side of the market, right? I was forced into doing that too. I'd have to take the other side of the market, and it wasn't a very liquid market, so I wasn't able to offset those necessarily with any other options. So what did I do? Well, I had to trade the stock. So of course you're selling those for higher and higher levels of implied volatility. So there's a benefit there potentially at some point. As implied volatility comes down, you get that Vega benefit from that quick win. But in the meantime, you are beholden to the market's moves, right? You're in the middle of you're in the eye of the storm of volatility, having to do things that you don't really want to do, which is sell to the downside and buy to the upside. So we'll have to see this week as we come up. I can kind of see us getting sort of towards that. This is a 60-minute chart, right up to that 60-minute period around 5,800, and then ultimately around 5,840. We'll see how this turns out. And then I think we have a little bit of trouble. We've got kind of this breakdown spot, which is going to serve as resistance right here, perhaps around 5,840 to 5,850. And that's where we're going to struggle a little bit. If we can get through here, that's going to look very interesting. And guess what? The implied volatility is going to start getting crushed even more. Unless the move is extraordinarily strong, then we're probably not going to see the VIX. We'll probably see it hang in there a little bit, but we're going to see it drop if this market keeps moving up, and that Vanna effect will become even more pronounced. Okay, so that's Vanna for you guys. We talked about it on the way down. We've talked about it on the way up. And hopefully that gives you a little bit of an idea of the movement underneath the hood for market makers. We'll see you next time.